this is actually a question. When we see here, we can see that they are given us two balance sheets. So definitely we are expected to prepare a consolidated statement of financial position, a balance sheet. And the data we discussed in the last class, in the last session, we actually spent 45 minutes on analyzing this thing. Now you remember that whenever you start with a balance sheet question, the things which you need to calculate are always like goodwill. And to calculate goodwill, you need to calculate net assets at acquisition. And of course, you need to calculate consideration. Then you have to calculate NCI at reporting date. Then you have to calculate group retained earnings at reporting date. Then you have to make sure the fair value adjustments. Then you have to make the calculation for PUP, which is unrealized profit. So these are very typical calculations or workings which you are expected to do. I mean, every balance sheet question will have minimum these ones. There might be more as well. And of course, when we are talking about SBR, because this question is from F7. So in F7, usually they do not give deferred tax. But in SBR, you will always have deferred tax calculation. You might have IFRS 2, share-based payment in that. Okay. So one adjustment is for IFRS 2. Sometime one adjustment is for IS 19, employee benefit. And probably sometime one adjustment could be for leasing as well. Or maybe for IFRS 9 as well. So in SBR, these things will be further added. But in F7 level, you are only talking about these top ones. So let's start with the F7 level. We said that it is our just kind of a quick bridging of our knowledge and make a quick revision. So we start with the goodwill. So in goodwill, usually the first thing is about consideration, which has been transferred to acquire the company. So we have read the question before. On 1st October, Paradigm acquired 75% of Strata equity share by means of a share exchange of 2 new shares in Paradigm Company for every 5 acquired shares in Strata. In addition, Paradigm Company issued the shareholder Strata Company a $110% loan note for every 1,000 shares. So, and these were not recorded, we remember it. So two forms of considerations are coming in from the parent. One was the share exchange and the other one was the loan notes. And then of course you will have the non-controlling interest as well. So if we need to see the share exchange, they are buying 75%. So the total equity shares are 20,000 in Strata. Out of 20,000, 75% has been 75% is purchased by this company called Paradigm. So you should be doing 20,000 multiplied by 75% multiplied by 2 divided by 5. So this is your proportion of the shares or the number of shares which you are going to issue. And the share price of the parent, not of the subsidiary, but of the parent, and parent share price is $2. So if we take it here, what we get, this is 12 million, and we can put here 3 zeros on the top. So we know that we are talking about 12 million. Then if we go to these loan notes, again, this is what we are acquiring, 75%. And for every 1,000 shares, we are giving $100. So this is the number of shares divided with 1,000, multiply it with 100. So this is the value of loan notes which we are issuing. And that comes out to be 1,500. After that, non-controlling interest. Usually it is given in the end how they value the non-controlling interest. It's not here, it is somewhere at the bottom. Yeah, Paradigm Company's policy is to value the non-controlling interest at fair value at the date of acquisition. For this purpose, the share price of Strata Company of 1.20 each is representative. So Strata Company share price. So you take it here, it is on the fair value, and you will take it like non-controlling interest is 25% of 20 million into 1.20. So this is the value of non-controlling interest. So total consideration transfer is 19.5 million. So this 19.5 million, which has been total given, and then you say net assets of Strata at the date of acquisition. So net assets of Strata at the date of acquisition, of course, we talk about, now here we talk about that retained earning thing, okay? Share capital you have. By the way, I'm sure that you remember previously that acquisition happened on 1st of October. Financial statements are 31st March 2003. So this is October, November, December, January, February, March. 6 months. It's in the middle of the year. So Strata Company had a share capital, and that share capital is 20 million, which we saw before. And what else do we have in the equity part? It said that they had equity shares, retained earnings at 1st April 2002. Now please pay attention. This is your timeline. We draw it before as well. We are preparing financial statements here. The beginning of the year is here. Acquisition happened somewhere here. Okay. So what they had there at this point, their retained earnings at the beginning of the year were minus 4,000. Then for during the year, they made some profit, and the retained earnings, they said profit for the year ended. Profit for the year ended is 8,000. This is not the retained earning. This is the profit for the year ended. So we need to find out how much is the retained earning balance at this point. Okay. At this point, how much is the retained earning? Total profit for the year is 8,000. And this profit, was it made equally throughout the year, or was it made for, it's for the year ended 31st March 2003? At 1st April 2002, it was minus 4,000, like at the beginning there. So last time, I think, Vishal, we made a mistake in discussing, because I remember that you and I were discussing that they were minus 4,000 here. No, they were minus 4,000 at the beginning of the year, 1st April. This is 1st October, and this is 31st of March. So how much is the retained earnings at the date of acquisition? Who can tell me? Please read this sentence to find out the retained earning balance here. Can you, from here to here? Now, can you, after reading the sentence, can you tell me what were the retained earnings on 1st October, I mean at the date of acquisition?
Loss of 2 million.
Okay, so it said that it had made a net loss for the year of 2 million at that date. So it means that it was a further 2 million loss in the first 6 months. So it means that at this point, the retained earning balance was minus 6 million. Yes or no?
Agreed, yes.
Agreed? And then
I
this
agree.
8 million is only for the 6 months, because they did not make profit in the first half of the year. So when the year started, their retained earnings were already minus 4 million. Then in the first 6 months, they further made a loss of 2 million. So until the date of acquisition, which is 1st October, their total retained earning was minus 6 million. And then they made a net profit of 8 million in the second half of the year. The second half of the year. So 8 million does not belong to the full year. 8 million belongs to only the last 6 months of the year. Okay. So we got it.
But sir,
Yeah.
sir, if you go down, it says for the year ending 31st March. Yes, yes. For the year ended 31st March 2003,
So it does not mean that. So it means, so for the year ended 31st March, what happened in the first 2 months, we made minus 2 million loss, and the total went up in 8 million positive. So it means that this period profit is actually 10 million. Do you understand? For the full year, you made a profit of 8 million. For the full year, you made a profit of 8 million. So first 6 months, you were making a loss. So how much you would have made in the next 6 months so that you end up?
Yes, yes.
So profit for the next 6 months is actually 10 million.
Right.
It is not 8, it is 10 million. So that minus 2 million loss plus 10 million profit gives you a net 8 million profit, right?
Yes, no.
So share capital is here, and we say retained earnings. Retained earnings are minus 6 million. And how do we get to this minus 6 million? It is minus 4 million and minus 2 million. And then you had a fair value adjustment. Always you will see it, fair value adjustment. It is given usually as a note number 1. It says that at the date of acquisition, Strata company produced a profit. Okay, no, this one, it is here. Also at the date of acquisition, Paradigm conducted a fair value exercise on Strata. Net assets which were equal to their carrying amount, with the exception of an item of plant which had a fair value of 3 million below its carrying amount. Fair value is also below. So usually we are adding fair value 3 million, but this time it is below. So 3 million will be subtracted here. So what is happening that they are actually, the net assets of this company were just about 11 million. Okay, the net assets were just about 11 million. So now we see that the company had a share capital of 20 million. Out of that 20 million, 6 million is gone by way of negative retained earning, and 3 million is gone by way of the downward revaluation. And what we have here now, your goodwill comes out to be a difference between this one and this one. So your goodwill is 8.5 million. So this is actually the first part. If we now see that what we have done, we have covered this fair value adjustment thing. We already have taken care of this area. We have taken care of this area. Then comes this one. Each month since acquisition, Paradigm sales to Strata were 4.6 million. Paradigm sales to Strata. So parent is selling to the subsidiary. Paradigm company had marked up these by 15% on cost. So this is sale value. 4.6 million is the sale value. There's a 15% markup inside. Strata company had 1 month supply of these goods in inventory at 31st December. Paradigm company's normal markup to third-party customer is 40%. I'm not sure why do we need this 40% to outsiders. It's not our concern. What we are talking about, what they are doing, they are making 15% markup. So let's see what is our unrealized inventory. So we say that here it is unrealized profit, and we say that closing inventory of goods. This is 4.6 million because it is markup. In case of markup, you should remember formula 15 divided by 1 by 15. If they tell you that there was a margin, then you should say 4,600,000 into 15%, and that's all. Margin is calculated like this. Markup is 15%, 15 divided by 115. We have done this calculation before as well, mathematically, why or how you do it. So your unrealized profit is 600,000. Then the next thing, point number 3, it says Strata company's current account balance with Paradigm company at 31st March 2003 was 2.8 million. So Strata company's account balance was 2.8 million, which did not agree with the Paradigm's equivalent receivable due to a payment of 900,000 made by Strata on 28 March, which was not received by Paradigm. So what is happening? This is parent Paradigm, this is Strata. Strata says that he owes 2.8 million. And of course, it did not match with the amount shown by Paradigm. The difference is that Strata had sent $900,000, and that money already been paid by Strata, but not received by the Paradigm, because there is some time in the transfer time which is taking. So P company, of course, the parent company, the Paradigm company, is definitely showing a bigger amount because it has not received the money. So, but Strata has paid. So what we need to do, we need to make adjustment for that. So this thing is called, intercompany, your transfer, you call it cash in transit. Sometimes you have inventories in transit. So we need to calculate for that as well. So what we need to do, that this company already has subtracted. We need to add 900 to parent because parent will receive it. So Strata parent company receivable will be decreased. So if you have parent company, what should happen? They have receivables here. We should make minus 900 from here because the money has already been transferred. It will be in their account in some time, and they should plus 900 here. Okay. So this is the adjustment which is needed, and we will do this thing when we will prepare the balance sheet numbers. Then point number 3, Strata companies. Okay, we did this 4. The financial assets, equity investment of Paradigm and Strata are carried at their fair values. Okay, we discussed that. We will just match these numbers with the numbers in the balance sheet. If there is any increase or decrease, we will recognize at gain or loss. So we do not need to make some working for that. Working is not needed. Paradigm fair value 7.1 million. And if we see what is in the balance sheet, it is financial assets were 7.5. So balance sheet says 7.5, market says 7.1. There is a loss here. We have to recognize a loss for the Paradigm. If we talk about the Strata thing, Strata company had 3.9 million market value, and previously in the balance sheet it was shown as 3.2 million. So 3.2 in the balance sheet, market is 3.9. There is a gain of 700. So a net effect of 300 plus is coming in. In equity instrument plus 300 you will do 700 plus 400 minus, etc. So that is also, we don't need to produce a separate working for that. We can actually do it at the time of making balance sheet. Then what we need to do, we need to make adjusted profit of Strata. We need to make adjusted profit of Strata because whatever is the profit for Strata for the year, because we have to divide it between the parent and NCI so that we calculate non-controlling interest at reporting date. Remember, we need to calculate NCI at reporting date. And in order to calculate NCI at reporting date, we need to know the profit so that from the profit, we give some part to the NCI. So we say that profit as per the financial statements. So how much is the profit given as per the financial statements? If you pay attention, it is at the beginning, it was 40,000. Then profit for the year is 8,000 positive. So it is as per financial statement. Let me write down like this. Beginning of the year, it was minus 4,000. Then acquisition date of, okay, let me call it like this. First 6 months. were minus 2 million. So acquisition date, the profit, the retained earning at the acquisition date were minus 6 million. This is what we did before as well. Profit for the year. There is 8.2. I think I don't need to make it like this. I also don't need to write down this one. We should only say like this one. We should say that first 6 months minus 2,000 loss. Profit for the full year was 8,000. And I would say that post-acquisition profit, which means last 6 months of the year, that is 10 million. Okay, this is what the number we need, because we have to divide the profit, which is the profit which is after acquisition. Okay, so what we need to pay attention a lot on this 8,000 number, okay, and this minus 4. I'll draw it again for you people. I mean, this is a little bit confusing. It may confuse sometimes, and if you get confused here, that's going to be a problem. This is something like this. Now, you should remember, this said you that the retained earnings, here the word used is retained earning. Retained earning means that whatever has been accumulated in the last years, whatever. So you had a net balance of retained earning of minus 4,000. So you had a net loss over the years accumulated minus 4,000. And then they told you in the question that in the first 6 months, a further 2 million of loss was made. So in the further in the first 6 months, you made another loss of 2 million. So it means that the net loss for the company, the net retained earning balance was minus 6 million until here. And this is the number which we have used in calculation of goodwill. And after that, they told you that the profit for the year, the overall profit for the year is 8 million. Overall profit for the year is 8 million. Now, I know that in the first 6 months, I already had made a loss of 2 million. So what I made in the next 6 months, what I had made in the next 6 months, so that my end result comes out to be 8 million. I mean, you were doing this 1 year. In the first 6 months, you were minus 2 million. So definitely, necessarily, you had made $10 million here in the next 6 months, because now when you make a sum total of minus 2 million and 10 million, you get a result of 8 million profit. Okay, now this is 8 million profit for the year. It says for the year ended 31st March. It is not your full retained earning balance. So you have to take this, that if I made minus 2 million loss in the first 6 months, the next 6 months, I definitely would have made 10 million, so that my net profit loss comes out to be 8 million for the year, It is not your retained earning balance here. Now, if I ask you, what is the retained earning balance here? You know how much will be the retained earning balance? You had 4 million retained earning at the beginning of the year. You had 8 million net profit. So if you ask me what will go into the balance sheet as my retained earning here, I would say 8 minus 4, 4 million positive will be your retained earning balance. It's like the mathematics. You started your year with minus 4 million. You made a profit of 8 million. So your closing retained earning should be 4 million. You should not be thinking that minus 4 and 10, it should be 14. It is not 14. 8 million is the profit for the year. So when I know that 8 million is profit for the year, 2 million I made a loss. It means that here it was 10. So 10 minus 2 gives me 8. When I started the year, I was with minus 4. Then I made plus 8. My closing retained earning should be plus 4. When you will make balance sheet in your retained earning at 31st October, this company called Strata will write down 4 million in retained earning. But this 10 million, we will divide it between the NCI and the parent after making some adjustment. So this is the profit for the year. We will consider that, fair value adjustment, extra depreciation, or probably there is an impairment or something. We will make that adjustment in 10 million, but this is something which should be distributed between, because the NCI and parent are not going to take their share from this 2 million because they were not here. Acquisition happened here. Parent is seeing only 10 million profit. NCI is asking its share from this 10 million. NCI has got nothing to do whatever happened before acquisition. Before acquisition is not our business. Our business is here. So we will be taking 10 million as a beginning point. We will make adjustment to this 10 million, and then we will divide that thing. We say profit. I call it post acquisition profit. Last 6 months of the year are 10 million, and then there is fair depreciation impact due to fair value adjustment. In many questions which you have done in past, in most cases, what happened that fair value, it always went up. When fair value went up, depreciation goes up, and when depreciation goes up, profit goes down. So fair value goes up means depreciation goes up, means profit goes down. And we always subtracted the extra depreciation. But in this case, it is opposite. We said that the fair value has gone down by 3 million. If fair value has gone down, then depreciation expense must also go down. And as a result, profit will go up. So we will find out the depreciation impact and we will add it. We will not subtract it, we will add it. So we know that fair value adjustment was 3 million. What was the life? It said that it was 3 million. Below its carrying amount, the plant had a remaining useful life of 3 years at 1st October 2002. From that date, 3 years. And we have to take 6 months impact. So I would take a number like here, 3 million. And then I divide it with 3, multiplied by 6, divided by 12. And what it gives me is 500. And we are going to add it. This will be added into this thing, not subtracted. And then if you think about this Strata thing, Strata had equity investment, and there was some changes in the equity investment. So equity investment in Strata, 3.9 million. If you see in the balance sheet, how much was in the balance sheet? In the balance sheet, it was given as 3.2 million. So there is a gain on the equity investment. Let me write down here, gain on equity investment, which is 3,900 minus 3,200, which makes me 700. So this is what I call adjusted profit. This is adjusted profit. Let me write down, I would say post-acquisition adjusted profit of Strata. This is the proper name for this thing. What is 11,200? This is post-acquisition adjusted profit of Strata, NCI share and parent's share. Of course, NCI is 25%, parent is 75%. So I take this 11,200 into 25%, and I take this 11,200 into 75%. So this much goes to the NCI and that much goes to the parent. Now, if I have to make, I say NCI at reporting date, NCI at reporting date, it is always equal to NCI at acquisition. And then you say plus NCI's share in post-acquisition retained earning of Strata. Post-acquisition retained earning of Strata. Acquisition NCI we calculated when we were doing at goodwill. NCI was 6 million and post acquisition is 2.8 million, and there is no impairment of goodwill, isn't it? I think there is no impairment of goodwill in this version. Yeah, I don't remember. And then you have to make group retained earning. Okay, group retained earning. Group retained earning is parents retained earning plus, I would say, plus parents share. Parents share in this one. So parents retained earning as per the financial statements. And let me write down as per financial statement. So how much is the parent retained earning for the year? Retained earning for parent is 19,200 plus this year 7,400. Both of these numbers you should add them up. You should say 19,200, the previous one, plus the full year 7,400. So this is what is as per the financial statements. 26,600 plus it will take 8,400. And then we need to do one more adjustment. Which adjustment somebody will tell me? Perfect. Unrealized profit, because parent sold goods. So unrealized profit should be subtracted from parent. And that was, I think, 600 somewhere here. And let me put it with -1. And then there is one more adjustment. Which one? Right? Parent also had equity instrument. Parent equity instrument in the balance sheet was 7.5 million, but in the market it was 7.1 million. So 7,100 minus 7,500. So what we get here is -400. So this should be subtracted. Now when you make a total, it gives you 34 million. This is your parent retained earning. Let me call it group retained earning. Okay. So group retained earnings are 34 million. So once you have done these calculations, like you have done your NCI at reporting date, you have done your group retained earning 34 million. We have done our fair value adjustment. We calculated our unrealized profit. We calculated our goodwill. We are ready for making our balance sheet. Let me take it here now. Let me drag it down so that we can see these numbers clearly. Yeah, here somewhere. This is the thing we need. And here we say consolidated SOFP for Paradigm Group as at 31st of March 2003. This is, first thing is going to be assets, and within assets we have non-current assets. Okay, and non-current assets, what do we get? We have here PPE, property, plant and equipment. And by the way, immediately you should write down here goodwill. I mean, you do not see goodwill in the individual financial statements, but in the group financial statement, you immediately write down goodwill after PPE, and then you will have your financial assets. So these are the things which we have here. So what are the numbers? The numbers are 47,400 plus 25,500 and plus that fair value adjustment, which you did, and minus the extra depreciation 500. If you see that we made this extra depreciation like this one, 500. So what we get here? We get here as, I'm sorry. Fair value adjustment was -3 million because it was not increasing the value of the asset. We were decreasing the value. So we say -3 million, but we say plus 500 because of that depreciation thing. So 70,400,000 is your PPE, and your goodwill was, I think, 8.5 million. Yeah, here it is, 8.5 million. And financial assets, we will take at the market value. The market value was 7.1 million and 3.9 million. If you remember, it was given here at the bottom, 7.1 million and 3.9 million. So we take these two numbers. It's pretty simple balance sheet. So these are your non-current assets. That's all. There is nothing else in the non-current assets. And we make it both. Then we have here our current assets. And in current assets, what you have, you've got inventories and you've got trade receivables. We have got bank. Okay, now remember inventories. This, which you did this 600 closing inventory value, you said the 600 is unrealized profit. The double entry for this 600 is always double entry, debit group retained earning and credit in group inventory. This is the double entry. Debit group retained earning by 600, which means decrease the group retained earning by 600 and we decrease by 600. Okay, this is the result of that debit. I mean, how do you put it here? You are doing it on Excel, but when you do your accounting system, how would you decrease it? You will make this double entry. You would say debit group retained earning by 600 and credit group inventory. Group inventory should also be decreased because within the group, you are showing inventory value. You say that within the group, inventory value has been shown as, in Strata company, it says inventory is 84. Within that inventory of 84, there is, I think, 4.6 million or something inventory which has been taken. And that inventory includes the profit. Okay, the rule is that the inventory in the group balance sheet should be recorded at the cost to the group. Okay, this is parent, this is subsidiary. Parent purchased something for $8, it came into the group, and then parent sold it here for $10. Now the subsidiary can say that my inventory is $10. For subsidiary, inventory is $10. Inventory is right. Subsidiary is absolutely correct. Subsidiary will say my inventory is $10. It is correct. But for the group, the inventory has value only $8 because this, for the group, inventory is $8 because the inventory came into the group for 8. So when you prepare group financial statements, you record inventory for 8. That $2, which is the profit, because that profit you cannot realize. That's why you call it unrealized profit. So that $2 was subtracted from the income statement profit, retained earning, and also subtracted from the group inventory. So this is one adjustment which we need to do to the inventories. So if we, let me take it here. like this. So if we have inventories, so how much are the inventories according to the balance sheet? It is 17,400 plus 8,400. And you should subtract from here this minus 600. This minus 600 means that unrealized profit, that group inventory. Then you have trade receivables, 14,800 plus 9,000. And from here, you should subtract this minus 900. Remember that intra-group transit thing, because subsidiary made the payment. So subsidiary already subtracted from its payable, but the parent had not received this 900. But we assume that parent will receive. So parent is showing this 14,800 because it is still including that 900. So like I told you that you should subtract 900 from here, from receivable, and plus 900 into the bank because it will appear very soon. So very simple. Just subtract this 900 from the receivable. It is called, cash in transit. And when you make your bank balance, you will say 5,100, and there is no bank balance with Strata, but you should add 900 there. So this is your bank balance. Now what we have got here, there is nothing else. And I can just make a total of these numbers. I would say current assets. And these were your non-current assets. So, and then we say total assets. So the total assets for the group are 89,900 plus 54,100. It is 14 point whatever, let me put it in millions. And I will put here 3 zeros on the top. So this is 144 million. This is the total assets for the group. And then we make our equity and liabilities. And in equity and liabilities, of course, we start with the equity, which belongs to the parent. Okay, we say that, let me call it share capital. And then I will call it retained earnings. So how much is the share capital? Now that is interesting thing, and that needs a little bit of calculation. We have got here, if you pay attention, the equity for the parent was 40 million, okay? 40 million. But should we show it at 40 million or not? I think we discussed this issue in our last session when we were making calculation, that parent had acquired 20 million, 75% of 20 million shares, and it is giving 2 shares for 5 shares at $2. So what are the number of shares? So it is issuing share. If you pay attention, that face value of share is $2, okay? And I'm sorry, $1. And market value of share is $2. It means that there is share premium. There is share premium of 1, and share capital will be 1. So when you are selling a share in the market for $2, face value was 1. So it means that $1 will go to the share capital, $1 will go to the share premium, and 1 is to 1. So how many number of shares you are getting? You are getting 20,000, but total equity shares. You are buying 75% of that, and you are giving 2 shares for every 5. So you are actually issuing 6,000 new shares. Let me call it also working. You should have shown this working for share capital, okay? Working for share capital. Maybe you should need to do some proper format. I would do it like this. I would say issue of new shares. Issue of new shares will be this much. 6 million. So 6 million shares into $1 will go to share capital. 6 million shares into $1 will go to the share premium. So share capital will be increased by 6 million, and share premium will be increased by 6 million. So the double entry is debit investment, credit share capital 6 million, credit share premium 6 million. So your share capital here, it will be done by what is shown in the question is 40 million. So I would say 40 million plus 6 million. So it is 46 million. Then let me put here immediately share premium. And share premium is also 6 million. So I take it 6 million. If there is any question, please ask me. If there is any confusion on this area, please ask me. So just one question which we answered. Let me speak it in the recording as well so that others will understand. When you make a group balance sheet, your consolidated financial statement, you do not like these numbers we have been making this or adding them together. Okay, we added all these numbers. If you notice that we were adding these numbers: parent asset plus subsidiary asset, parent financial asset plus subsidiary financial asset, parent inventory plus subsidiary inventory. But we never do parent share capital plus subsidiary share capital. No, you will only show parent share capital. Subsidiary share capital will not be shown in the group balance sheet. Why it will not be shown? Because you have this share capital on the credit side, and on the debit side you have investment which you made to acquire the company. So on the debit side investment, on the credit side the share capital, they are cancelling out each other. These are called like items. Like, the money from one pocket, it goes to another pocket. It is just like it is within the group. It is coming from one company to another. So it is being cancelled out. It will not be shown anywhere. If you pay attention, if we go up, what happened? So what we gave as a group, including NCI, because the group balance sheet will include non-controlling interest, together we paid 19.5 million for a business which had a worth of 11 million. So this 19.5 and 11, the difference was 8.5, which is extra, and that is called goodwill. Only this will be shown in the consolidated balance sheet. Like within this 19.5, 11 is cancelled out. Okay, if you subtract 19.5, if you subtract 11, what is remaining? 8. So this 11 and 11 inside here, I'm cancelling out with each other, and only the difference 8.5 will be shown. 11 will not be shown. So this 8.5 difference we will only show. If you pay attention here, we did not show our investment here. So on the asset side, we are not showing the investment. On the credit side, equity side, we are not showing the share capital. So that share capital and investment, to the extent of equality, 11,000, they are cancelling out. The difference 8.5 will be shown in as the goodwill. Then you have retained earnings. Now, how much are the retained earnings? So here you write down your group retained earnings. We calculated group retained earnings somewhere there. I think it was 34,000. Now what you have: share capital 46 million, share premium 6 million, and group retained earnings 34 million. We make a total of this number and we call it equity attributed to the owner's equity, attributed to the shareholders of parent or the group, or let's call it, keep it simple, to the group. This is your group to the parent. I'm sorry, not to the group, to the parent. Equity attributed to the parent 86 million, and then you must show here NCI. NCI also is part of equity. Okay, so how much is NCI? So NCI was your 8.8 million. You write down this one as well. So this is the structure of the balance sheet you should remember. First, you show the share capital, which belongs to the parent company, plus any new shares. In our question, because why are we adding the 6 million? Let me go back and tell you. I mean, when we were discussing this thing last lesson, we said that it said that Paradigm Company has not recorded any of the purchase consideration. Like Paradigm Company issued shares and it also issued some loan notes. It did not include the shares and did not include the loan notes. These were missing within these balance sheet. So we included the new shares. Okay, if the sentence was not given, they told us that they did not record, and therefore we know that this 40 million shares, this equity share or the share capital 40 million, this is before the share exchange. The new issued shares are not included. So we included the new issued shares and we also included the share premium. In many questions, this sentence will not be given that it was not recorded. So then you just take 40 million. If they had not told you, you should have taken 40 million. But because they told you that it was not recorded, so you are doing it now. And please do not forget that your consideration, it consisted of two parts. Your consideration consisted of share exchange. This 12 million, 6 million capital, 6 million premium, you just recorded. There were loan notes also. And these loan notes were also not recorded. Like if you see the balance sheet here, the non-current liabilities, if you see the non-current liabilities, it said that loan notes 8 million. This is without that 1500. So you need to add that 1500 of share, consideration. When you purchase company, you give loan notes. It was not included. So you should add that also. Anyways, structure is first I show my capital, which belongs to the parent. Then I show my NCI. So this is called 8.8 million. And then you should say your next line was, what is the next line here? So we have loan notes, this one. I would say non-current liabilities. Okay, so this is your next line, because equity part we have done. Non-current liabilities, you have loan notes, and loan notes you should write down 8 million plus 1500. That 1500 which came from working one, okay, when you did consideration part. So this should be added. So non-current liabilities are done. Then you have your current liabilities, and current liabilities are trade payables, and they have got bank overdraft. That's all. There are only two of them, payables and bank overdraft. So your payable are, how much are payable? Payables are 17,600 plus 13 million. And then there was intra-company receivable and payable balance. Remember that 900 was not matching with receivable, but the total balance was more. Let's read this one. It said that Strata Company's current account balance with Paradigm Company at 31st March was 2.8 million. 2.8 million was from Strata. Strata was the one which made the payment of 900,000. So after paying 900,000, it was 2.8 million. So it means that this 2.8 million is the final balance. That is the correct balance, because it already had paid 900,000 and subtracted. So 2.8 million is the payable balance, which you call intra-group payable. So I would make it payable 17,600 plus 13 million and minus 28. And this is my payables. And then what is your bank overdraft? Bank overdraft is just 9.1 here. And we make a total. We say that total equity and liabilities. Okay, let's make a total of this number. So we know that this is my current liabilities, this is non-current liabilities, this is equity. So we'll take equity of the parent plus non-controlling interest plus non-current liabilities plus current liabilities. It gives you 141,200. And here it was 144,000. I know where we made a mistake. Can somebody tell me where we made a mistake? If I give you the number, you will
interest on the loan, sir.
No. If I just give you this number, 2,800. Asset side was bigger than 2,800. Remember what this trade receivable, if you see here, trade receivable, we added both of them, we subtracted this, but we need to subtract that 2,800 also. Intra-group receivable payable are subtracted from both sides. So you should say minus 2,800 and minus this 900, which was the wrong adjustment. But 2,800 should be subtracted from both sides. That we did not do. Now balance is equal. I mean, we did this 2,800 on the liability side, like this one, this 28. And this 28 should also be subtracted from here. We forgot to do that before. Now when we subtract it, both sides become equal. This should be your answer, 100 and 41,200. Any question if you have from here?